So you pull in almost $84 million in a single quarter, up 67% sequentially. And the market rewards you by dumping your stock at the opening bell. Welcome to Earnings Unscripted. It's August 13th, 2026, and today we're looking at Ondas Holdings, ticker ONDS, and their Q2 report that, has everyone totally divided.
It's divided for a good reason. You look at the top line and it looks like a breakout military tech company scaling hard. But then you peek at the bottom line and see they swung to a net loss of 19 cents a share from a pretty big profit last quarter. The spending here is, it's aggressive, to put it mildly.
Right, and investors clearly balked. The stock gapped down hard pre-market and stayed deep in the red all day. And since we're sitting here judging the market's panic, I should mention this is entirely our own analysis today, not investment advice for your portfolio. But Miro, what exactly are they spending it all on?
Infrastructure for what the CEO calls an exponential S-curve.
The infamous S-curve, the ultimate corporate get-out-of-jail-free card for burning cash, right? Like, don't worry, guys, we're not losing money. We're just at the flat part of the curve before the rocket takes off.
Usually I'd agree, but to be fair, they're building heavy physical defense systems. We're talking drone jamming tech, lethal unmanned strike drones for the Army, and they just highlighted a massive strategic pipeline, which is a huge leap from where they were. But to deliver on that, they're pivoting from selling standalone widgets to integrated systems of systems.
Okay, wait. Systems of systems? Like tying all the tech together on one screen?
Exactly. So instead of just buying a radar, a base commander buys the radar, the cyber takeover tool, and the kinetic strike drone all networked. The catch is that assembling all those hardware mixes puts incredible pressure on their margins. Their gross margin actually ticked down a bit this quarter.
Got it. Growth is up, but it's costing them more to stitch it all together, which probably explains why they're acquiring companies left and right. But there's this wild story in the transcript about how they're digesting those acquisitions. I really need to know if they're actually letting Palantir AI agents run their corporate integration on GovCloud, or if that's just some futuristic buzzword soup.
It sounds like buzzword bingo, but it actually isn't. They really plugged Palantir's Foundry system into Microsoft Azure GovCloud to run their post-merger integration.
Okay, so Skynet is basically running their HR department now.
Sort of. They just bought a company called Worldview, right? And usually integrating a defense contractor's supply chain takes months of miserable spreadsheet mapping. But Ryan Hartman, the head of Ondas Sentinel, said on the call, Foundry dramatically accelerates integration, allowing us to bring newly acquired organizations into the Ondas ecosystem in a fraction of the traditional timeline. They essentially let AI agents rewrite and merge disparate inventory systems in literally minutes.
That's incredibly cool, but here's my problem with it. If the AI is saving them so much human overhead, why are their operating expenses just completely blowing out? We're talking about almost $200 million in total OPEX this quarter?
Because the AI is fixing the corporate integration, but the physical hardware scaling is burning the cash. Out of that massive expense, a huge chunk is non-cash stock compensation. But they also broke out about $26 million specifically for what they call front-loaded investments in their Warp Speed and Skyweaver platforms.
Right, so that's the S-curve excuse we mentioned earlier, spending heavy today so they can actually fulfill those giant military contracts tomorrow.
Exactly, and they're staring down a strategic pipeline that just expanded to over $11 billion. You don't build out physical capacity for that on the cheap, but here's the quiet part they slipped into the accounting footnotes, and this is where it gets a bit murky. Starting this quarter, they formally changed how they calculate adjusted EBITDA to explicitly ignore changes in the fair value of contingent consideration.
Okay, wait, hold on. Walk me through that again, but in English. Contingent consideration. You're talking about earnouts, right? Like the bonus payouts they owe the founders of the companies they just acquired. Are they just pretending that extra cash doesn't exist on the balance sheet?
Well, let me say that better. It doesn't disappear from the balance sheet, but they're pulling it out of their adjusted operating metrics. It's a non-cash adjustment on the day they reevaluate what they owe. We saw a rough $19 million swing against earnings just from that line item alone. So by redefining the metric, they erase the penalty of those deal-specific liabilities
deliveries from their headline-adjusted profit.
Oh, I really don't love that. You're effectively masking the true volatility of your M&A spree from the profitability metrics. I mean, sure, it smooths out the lumpiness, but it also kind of hides the chaos.
True, but they clearly feel they need the numbers to look smooth right now, because even with their adjusted EBITDA loss widening to about $51 million, the management team made a very aggressive promise. They pulled their profitability timeline forward and expect to hit platform-level operating profitability by the fourth quarter of this year.
That's barely a couple of quarters away. If they're front-loading all this cash under the assumption of a massive revenue spike, what happens if supply chains just stall out and push those lethal drone deliveries into next year?
Then they completely miss the profitability target. It's that simple. The entire front-loading strategy only works if the timing holds. They've built this massive cost structure assuming flawless execution on these Department of Defense deliveries.
That's probably why they were so aggressive with their outlook. They clearly believe the volume is coming. Management raised the full-year revenue target to a range of $525 to $550 million.
Right, and getting there requires a massive sequential jump next quarter. They're heavily leaning on that Department of Defense contract. The CEO actually said on the call, if we execute against the planned fourth quarter ramp, we expect to exit 2026 at $1 billion in annualized run rate revenue.
A $1 billion run rate for a business at their current size is wild. But you can't fault the ambition. They're trying to capture lightning in a bottle while military demand is completely reshaping, especially with the drone conflicts we're seeing globally right now.
Exactly. The demand is absolutely real. But now they actually have to build the systems and ship them without breaking the supply chain. Next quarter isn't just an earnings update. It's a referendum on their entire execution thesis.
No pressure, guys. Just a referendum on your entire reality. I guess we'll find out in 3 months if they built a sustainable machine or just burned a lot of expensive fuel. Always fun making sense of the madness with you, Miro.
Always a pleasure. See you next time.
If you're enjoying the podcast, you might want to hit follow so you don't miss our next deep dive. And just for total transparency, we're both completely synthetic. This whole episode was written and voiced by AI from top to bottom, going from the earnings call to your feed the very same day. Turns out AI agents aren't just for military supply chains. We'd love to hear your feedback or ticker requests. So drop us a note at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for tuning in.
See you next time.